Hello, this is Michael Loftus for our mid-month update. Now, I've got a lot of questions about, Michael, how come you are so bearish? But, like everyone else, I love a bull market. But, is it time to change our thinking a little bit? Let me see. So, not just changing our shirts, but maybe our thoughts on the market. We're seeing signs for both bulls and bears, and we'll discuss that coming up. Stay tuned. Hello, this is Michael Loftus, and welcome to Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget you can click Show More for additional information and links to today's video. Also, if you find this video of value, please do consider subscribing. So, first up, let's get to the numbers. Week ending 8/17, and we continue to see a bullish side here, especially on the wings with the NASDAQ and small caps, but very strong in the middle as well. On the sectors, continue to be strong on discretion and healthcare. Let's go to the big charts. Been showing this one for a while now, so it looks good, but, well, it looks good because we've broken above that box, which is a good thing. We got up where that blue line is the gap towards all-time highs, and as you see, we kind of got above it, and then we failed, and then Thursday and Friday, we hit up against it 2 days in a row, so a little bit telling. For more details, we look here at the bottom. Volatility continues to be low. A lot of complacency in this market. Momentum, you see a slight crossover to the downside. So right now, yeah, a little bit of volatility. We'll see where that takes us this week. And at the top of the chart is RSI, relative strength. Hasn't really been a lot. We're above 50, but not doing much more than that. Now, despite that, we are on the short term positive, which is bullish. Next up, midterm weekly chart. As you would expect, bullish because we continue to be up in that channel from the 15-16. Momentum is pointing up. Relative strength has a way to go. So, midterm view is positive and is also bullish. Number 3, monthly view. What you'll see here is, of course, very much bullish, right? Everything's in an upturn. Not too much worried about this, except at the top a little bit overbought, but not crazy. As you see, we can sustain that for quite some time if it's bullish, to be determined. So, when we look at all these previous charts, of course, everything continues to be bullish. And if you look here, it shows us our secular bear and secular bulls, okay? And we're very much in a secular bull market. But this is where I change my view a little bit. When you start off with the most important recent news, Turkey. So what happened here? What happened was what started in 2008 when we saw a flood of liquidity into the market, whether it's companies, nations, banks, whatever, everybody was borrowing, and this, at some point, you got to pay it back. So you have low rates in Turkey. All of a sudden, inflation starts spiking, and wow, look at that. You've got their treasuries up to about 20%. Of course, their lira has crashed. Markets are down. They're in a bear market. A lot of issues here. The question is there a possibility of contagion? We don't know yet. I heard somebody say like last week, well, you know, it's like Greece a couple years ago, and, you know, the size of Rhode Island, no big deal. Well, Turkey's the size of Florida. Kind of a big deal, right? Because it's bigger than Rhode Island, but we're not sure yet. Let's see what happens because it's too early to tell. And what happens? Does the ECB step in? You know, we just don't know as of now, but it's not a pretty situation. But overall, emerging markets, international, is in a tough place right now, and especially when you add in the rising dollar. Had a video a couple weeks, I talked about why you don't have to be in emerging markets or international, and this, again, reaffirms why. So another sign here, it's not just there. Look here, our debt right now each percentage point up is going to create between 150 and 200 additional dollars to be spent to pay down our debt. 10 years, we're talking about $2 trillion extra dollars just in interest payments. That is a big concern. I've talked about this in the past. There's no white paper. There's nothing out here to tell us, well, we went through this in this year, meaning flooding the markets with liquidity, and here's how it worked out. We just don't know yet. I do know that our deficit's at $21 trillion, and that scares me. Looking at the charts, the rotation, are we seeing it yet? Not quite, a little bit stronger than a couple weeks ago. Starting at the top is value. So we're seeing a little bit of a move to value, but we've hit some resistance. We'll see what happens. But the bottom two, the lime green, is consumer staples and then utilities. Two what I'll call cyclical defensive sectors, and they are both moving up nicely. So want to continue to watch that, but that is also a sign. Here's another chart, equal weight versus the S&P. Remember, the S&P 500 index is cap weighted. So the bigger the company, the higher the percentage. 98% of the return this year is coming from 5 companies. So you take equal weight, 1/500th, everybody's equally weighted, okay, versus the S&P, and you can see we've seen a breakdown, a really big breakdown. Most importantly, we're at the lowest levels in 6 years, and it just shows the lack of market breadth. So next up, housing. You know, we've talked about this in the past as well. Obviously, we know what happened in 2008. I don't think we're there, but look, series of lower highs. You've got lumber at the top coming down quite a bit. Everyone thought lumber was going to go up because of tariffs. Not happening. But what about the consumer, Michael? I hear that they are spending money. I don't know about that because you look here, inflation, 2.95%. It's affecting everybody, going back to school, buying school supplies, clothing, groceries, you name it, everything's getting more expensive. So much so that you look at wages, real wages, which are what we've seen kind of coming up, but not keeping up with inflation. So real wages continue to go down. People aren't really spending money. Seeing it right here in our beach community, we get a lot of activity in the summertime, and we're down quite a bit from last year. We're not seeing full-time rentals. We're seeing 3-4 day rentals, and restaurants, etc., are down quite a bit because people don't have money in their pocket. And where is it? It's in debt. $13 trillion in debt. All-time high. So another reason to be a little bit concerned. How about manufacturing, ISM? Again, a series of lower highs. So concerning there, and ISM orders are down as well. So what have we done about it? Well, there's a couple things. First off, reduce company risk. So we've been taking profits where we can. All right, raising some cash, and let's wait and see. So I joke, I don't have a neutral shirt. Maybe Michelle can put that on here. But right now I'm neutral. I mean, you see signs for bulls, right? We also see signs for bears. So right now I am definitely neutral, waiting for opportunity, which is really not presenting itself as of today. Next up, tweets of the week. First up, Jim Stewart, a new follow, put out a nice chart. S&P about to hit all-time highs, but only 3% of companies are at 52-week highs. There's the market breadth I'm talking about. Scott Miner, very highly respected economist. If there were a moment to harvest gains and reduce risk, August 2018 would be it. And if it turns out not to be the moment, I don't think you're giving up much upside. Very interesting, but as you can probably tell, I followed that. Next up, David Rosenberg, again, another great follow. Look out below, the non-manufacturing ISM business index just fell most in any month since 2018. Interesting. Next up, treasuries and currencies. So splitting this up now, Treasuries, we talk about 10 minus 2, 10-year minus 2-year, continue to be very low. As we head lower to 0, get inverted, that's where we start looking for inflation. And a lot of the big talk recently also has been the dollar. The strong dollar, especially what's going on with Turkey. You see here a reverse head and shoulder. You can see the left shoulder, right shoulder, the head, and then the neckline and breaking out. That's very bullish. So continue to watch this. Why? Because as we're talking about emerging markets, U.S. companies that are doing business over there, 40 to 45% of earnings are derived from overseas. With a stronger dollar, those cost of goods get more expensive. So we have to continue to watch that as well. On my radar. Well, not much. I'll go back to that slide earlier. I'm looking at these cyclical plays right now. Are they going to continue to get stronger and or break out? We'll bring more of that in our next video. Wrapping things up, fear and greed. 54 this week, down from 60, so pretty much in line where I am. Neutral right now. As always, we appreciate you watching. Michael Loftus for Wealth and Wisdom TV.